Hello and welcome back to our YouTube channel Watching to Grow.
In this video, I'm gonna give you piling up, flourishing financial instruments that are yielding consistent higher returns than trading in stock market. We often hear the word stock market trading nowadays. Everyone aware of it and started investing on it without having proper knowledge. The result is loss. Yes, you need a huge patience and knowledge to play in the stock market. But remember, not only stocks gives huge return but also lot of financial instruments do. Let's see what are those. Watch this video carefully, and if you didn't subscribe to our channel yet, subscribe to it now. First one is ULIPs. Unit-linked insurance plan offered by life insurance companies are excellent insurance, aka investment plans, which serve dual purpose of providing a life cover and an opportunity for wealth creation over the long term. The premium paid toward a ULIP is invested in the market, thus allowing the investor to earn market-linked returns, and at the same time there is a fixed sum assured in the event of death. Policyholder can choose to invest in equities or debt funds as per his own risk appetite. Aggressive investors with high risk-taking capacity can opt for equity funds, and conservative investors can invest primarily in debt funds or even a combination of the two. One can also move from one fund to another as and when desired. The tax advantages are: 1. Premium paid up to 1,50,000 is exempt from tax. 2. 5 years lock-in period. 3. Entire amount is non-taxable once it is matured. Thus, ULIP is an excellent combination investment option for investors looking for market-linked returns along with tax benefits and a life cover. Tax-free bonds. Tax-free bonds are long-term investment options primarily offered by government-backed entities with minimal default risk. These bonds come with investment tenures ranging from 10, 15 to 20 years and pay a fixed coupon on the investment amount. The interest income received from these bonds is completely exempt from tax, and there is no upper limit for investment in these bonds. However, the interest received on such bonds is very nominal. Tax-free bonds are good for conservative investors looking for a fixed interest income over a long term. Real estate. Real estate has always been considered as one of the most lucrative investment options, as the investments in real estate fetch returns in two ways: as rental income and by way of capital appreciation at the time of sale. The location of the property and development around its vicinity are important factors that determine the returns on real estate. However, real estate is an extremely capital-intensive investment, and real estate as an asset class is extremely illiquid. More and more people are realizing this fact, and with the evolution of financial markets in the last 2 decades, not too many people opt for real estate as an investment. It is ideal for investors who have surplus funds and have no requirement for such funds for a long term. Equity mutual funds. The mutual fund industry has grown manifold in the last 2 decades. Equity mutual fund schemes are very popular investment choices amongst investors who want to invest in equities, as these funds invest in equity stocks of various companies. As per Securities and Exchange Board of India (SEBI) guidelines, any scheme to qualify as equity scheme must invest minimum 65% of its total corpus in equities and related instruments. Equity mutual funds can be managed actively or passively depending upon the scheme. The minimum investment in a mutual fund scheme can be as low as Rs. 500. As these funds are professionally managed, equity mutual funds are a good option for investors who are looking to invest in the stock market but do not have the expertise for the same. Debt mutual funds. Apart from equity mutual funds, investors can also look at investing in mutual funds through debt funds. Debt funds invest most of their corpus in fixed interest securities such as bonds, government securities, treasury bills, commercial paper and money market instruments. One can safely look at investing in debt funds without having to take the risk of equity funds and enjoy the safety of traditional debt instruments at higher returns. Factors to consider before investing. Tenure, the duration for which you want to invest your money. For example, the ideal choice of investment for an investor looking to invest for a year vis-a-vis someone looking to invest for 10 years or more will be very different. Financial goal, you should be clear about the future goal or goals you wish to achieve through your investments. Goals can be anything from wanting to build a corpus for child's education or marriage, buying a house, planning for retirement, etc. Liquidity is another aspect to consider while making investments. Some assets like real estate may provide higher returns, but not suitable if you are looking to invest for a short period of time, as real estate is most illiquid asset. Risk-taking capacity, the return generated by any investment is directly proportionate to the amount risk associated with such investments. The choice of investment should match your risk-bearing capability. A conservative investor would not be comfortable investing majority of his surplus in high-risk investment options. Taxation, certain types of investments such as PPF, LIPs etc. are extremely tax-efficient. However, investments in such instruments should be a part of your overall financial planning and not the entire financial planning in it. Hope you've gained some idea about financial instruments. Investing can be a great way to build your wealth over time, and investors have a range of investment options, from safe lower return assets to riskier, higher return ones. So always learn before you leave. Let's catch you up on another video on another day. Until goodbye.
Subscribe to our channel and click the bell icon to get notified.